Hi and good afternoon. I'm Robyn Hall, Publishing Director of Mortgage Introducer, and welcome to our live webinar in association with Proportunity. Can you believe it's now a staggering 346 days since we first went into lockdown, and with the news of yesterday's budget still fresh in everyone's minds, and children due back at school on Monday, could this be an opportunity for you? As we hurtle towards June 21st and the easing of restrictions, the changes announced yesterday will have an impact on your business. And we'll be coming to some of those later on. But primarily, we are here today to talk about Proportunity and the opportunities it can give you and, of course, your clients. I'm joined today by Proportunity Head of Lending, Matthew Froggatt, and Head of Business Development, Stefan Rusu. And joining them, of course, is industry legend Walter Avrili, Technical Director at Mortgage Force and a good Proportunity advocate. Thank you all for joining me. Now, this is a live broadcast and we will be taking questions as usual. We do have some that have already been submitted, but please use the Q&A function you can see on your screens below, and we'll do our best to answer them in the time that we've got. But to kick us off, we're going to hear a little bit more about Proportunity and how it can work for you. So Matthew and Stefan, over to you.
Thanks, Robyn. Good afternoon, everybody. Can you hear me well, Robyn? All good? Let me share my screen quickly. There you go. Can you see my screen? Wonderful. So yeah, good afternoon, everybody. Thanks, Robyn, for the invitation and for organizing this webinar. As Robyn said, I'm Steph Rusu. I'm in charge of distribution and business development at Proportunity, and joined by my colleague Matthew, who's our head of lending. Now, some of you on the call might already know about Proportunity, but for those of you who don't, I'll run through a few slides that will give you a bit of a flavor, a short primer for roughly 10 minutes on Proportunity and who we are, and then move to the more interesting part of our webinar, which is the Q&A, and give an opportunity to my esteemed colleagues, Walter, Matthew, and Robyn to discuss. So what's Proportunity? I think we're effectively a private sector version of Help to Buy. The only private sector version of Help to Buy that actually works. We've been doing this actively for the past 2.5 years, and growing our customer base and distribution at an accelerated rate. But firstly, before going into our solution, I wanna take a step back and look at the problem we're trying to solve, and the next generation on the housing ladder. And if we look at some of the stats, they're staggering. 9 million renters in the current market want to get on the property ladder. That's roughly 85% of all renters in the UK. They want to own, but unfortunately they can't. And if we look a bit at the numbers again, over the past couple of decades, and we see, and we all know how property prices have gone up, and unfortunately incomes have not done the same. This means over 200,000 first-time buyers have been left out per annum from getting on the property ladder. So what are the main reasons for this? And two principal reasons, which are deposits and affordability. These are the main barrier to getting on the housing ladder for roughly 7 in 10 first-time buyers. And if we look at the solutions, we at least don't think there are really any solutions in sight. So high street lenders, banks needs large deposit to mitigate house price risk, which is understandable. Because they have regulations and capital requirements which deter them from doing this low deposit lending. Moreover, the current pandemic health situation we're in made things worse as banks became more risk averse. And what does this actually mean for first-time buyers? It means that your 5% deposit that you had in December 2019 or January 2020 is not the same as it is now. So you need at least 10-15%. So you need to basically triple that. Now, if we look at some of the options out there, like Help to Buy, which currently solves around 10% of the first-time buyer problems, we all know it's tapering and eventually ending in 2023. And obviously, the elephant in the room, which we'll probably discuss later in the session around the recent budget announcement and the fact that we will have a mortgage guarantee product. But if we look a bit back in 2013, when Help to Buy was introduced, we had a twin brother of the mortgage guarantee, which pretty much looked the same, but it didn't get the same traction as Help to Buy. And the main reason for that is affordability, right? So that's kind of, in a way, we think the main constraint for first-time buyers. So if we now go to the solution that sort of Proportunity is offering, we can split that into it's twofold solution. So at the base of that is basically our technology, which is forecasting technology meant to de-risk lending. So I'd like to call it the automated valuation model 2.0. And the way our technology works is we first are able to provide an accurate valuation today, right, which is basically an AVM tool. But we take that a step further, and we're able to look at how property prices are going to look like in the future. And we do that by looking at multiple data sources and transactions in the UK and other data sources at the macro or micro level around property characteristics or specific events that happen in a neighborhood, for instance, a regeneration project or anything like that. And then we look in the past, because we all know, if we look at the property prices over the past couple of decades, we know that some areas have outperformed others. And what our technology is trying to do is understand what triggered the outperformance. And we've been working on this tech for over 4 years now, 5 years actually, just with the objective of understanding what are the elements that trigger an increase in neighborhood properties above average. I think in a nutshell, just to summarize, we like to consider this as a tool to risk score properties. So over and above, the customer credit scoring we do in our underwriting process, we also have an element of risk scoring the property. So that's basically the underlying technology. The second element of our sort of solution is basically our product, which, if I'm sure you're all familiar with Help to Buy, and if we take a sort of a typical stacking example, a high street bank would come with around 80% LTV mortgage. Customer comes with 5%, and we top that up with around 15%. So we bring their overall deposit to 20%. So what does this actually mean? In case he's 25 years old. And how did we actually able to help Rob? First of all, he was able to buy at 25. And we all know that the average first-time buyer age in today's market is probably somewhere between 30 to 35 years old. So we basically enabled Rob to buy at an age that probably his parents were able to buy. So 5 to 10 years earlier than normal. Secondly, we've enabled him to increase his budget from 250 to 330,000, meaning he was able to buy a property that was closer to his workplace, as well as a more central location. So basically, he was looking at zone 1 and 2 London. And because of this increased budget, we're able to widen his scope in a way, his property spectrum, by increasing the homes in his budget by around 15 times, because he all of a sudden jumped from 250 to 330,000, meaning much more one-bed flats within that budget. So this is basically the customer solution from a customer angle. But if you're a mortgage broker, you would want to see, okay, so what does this actually mean in financial terms? How much do they have to pay? And here on the next slide, we have a few scenarios that we're running through. So on the left-hand side, we have let's say a 200,000 typical sort of property, where obviously in today's world, the customer needs to come with 10% deposit, and they will be getting a 90% mortgage from a high street bank. Obviously, we've used some sort of generic rates. They would probably be paying around 840,000 per month. Then what happens if we plug in the same property price, we plug in a Proportunity equity loan? This means all of a sudden the customer has his own 10% deposit, 10% equity loan, and then we're actually able to deleverage the main bank from 90% LTV to 80% LTV. What does this mean? It means all of a sudden they're actually able to access a better rate with the high street bank, and this results in a combined monthly payment for the same property, which is lower than if they would go alone. And the more interesting bit, which I kind of touched on the previous slide on the right-hand side, is the fact that we're enabling him to buy a bigger property. because he would go to a high street bank, he would definitely max out, let's say 4.5 times his income, get the Proportunity equity loan on top. In this case, it's 50K, but we go higher, we go up to 90K. Customer deposit, which needs to be a minimum of 5%, in this case 20,000. So as I said, we've managed to help him buy a 65% larger property. In his case, it was buying a more central location. Other customers, for instance, want to buy a 2-bed instead of a 1-bed, or they want to get a house instead of a flat. So there are different scenarios, but we help in all of those scenarios. So we're not, while we are a young lender, we operate under the same sort of high standards as each FCA regulated lender. We have a second charge FCA authorized lender already in place. This is an intermediary only product, so our customers get advice on both the main bank, on both the first charge mortgage and the second charge mortgage, that are taken in tandem at the point of purchase. It's the great thing about this is, from a customer outcome perspective, is that we have independent underwriting and lend decision for each loan, which means a second pair of eyes on on all borrower information. So both the main bank underwriters and Proportunity underwriters would look at the same case, which means, in case there is some sort of human error, the other pair of eyes are able to spot that in a way. And more importantly, I think from a distribution perspective, we've designed this to fit in the current way of doing business for brokers, in the sense that we use the same valuation that the first charge lender conducts for their bit of the loan. We use the same solicitor. We have just to ensure we have a single conveyancing process with the same solicitor. The charges are registered sequentially at land registry, and everything is, in a way, we've tried to make it that, in a way, because it's a loan taken at point of purchase, we don't want to sort of reinvent the wheel, in the sense that you're doing some processes already for the first charge application. We want to sort of fit in that process as much as possible. In terms of our customer focus, obviously, as a relatively young lender, we at the moment we're focusing mostly on prime borrowers with strong earning potential, that are at the beginning of their career, at the beginning of their housing journey, first-time buyers looking to buy their first property. But it doesn't mean we don't lend on second steppers, so people who are looking to buy a bigger property or kind of move on from their existing property. As long as it's not a buy-to-let investor. They could be a buy-to-let as long as it's their owner residence, so this product is used for their main home. So this is the solution. We're Proportunity, who's basically behind us. So Proportunity, there are two elements when it comes to funding. One is the venture capital side of things, that basically is the funds we use to grow the business, invest in our distribution, to grow our basically our capacity to lend. And secondly is the lending capital we have to deploy in loans. And on the left-hand side, you can see some of our partners. And I think more importantly, on the right-hand side are basically our customer backers. So you have some examples of customer testimonials on the right-hand side. We take great pride in being a very customer-centric lender. And that's proven by the fact that we are the highest ranked mortgage lender on Trustpilot at the moment. And if we were to exclude the digital banks that don't do mortgage lending, such as Revolut, Monzo, etc., we're also the highest ranked bank. Obviously, we're more at the beginning of the journey, so we'll aim to kind of keep that high sort of customer feedback and being close to the customer as we progress and grow our business. So that's in a nutshell about Proportunity. As I said before, right-hand side is me, Matthew is on the left-hand side there. You're going to hear from here soon. I'm going to pass on the virtual floor to Robyn.
Thank you, Stefan. That's really a lot of interesting information to take on board there, and a bit of a hidden secret, I think, to a lot of brokers out there. Before we get into some of the questions that we have had submitted, just a reminder to the people watching, we are taking live questions, so feel free to use the Q&A. But Walter, you've been in this game since 1984, and Proportunity is something a little different to what we've been used to. What's been your experience of Proportunity, and how has Mortgage Force been able to utilise its offering to its clients?
Oh, well, good afternoon, Robyn, and everyone listening or watching. Yeah, I mean, look, second charge mortgages or top-up mortgages are not new. I mean, these things won't go back to the early to mid 80s. So the concept is not a new concept. You know, second charge loan on top of a purchase, simultaneous completion is not new. And so it's, you know, I've been dealing with them. I think they went up to 1990s, the mid 90s. They stopped. And incidentally, the first top-up mortgages were on new build properties mainly, and the actual developers were guaranteeing them. So we've kind of gone full circle in many ways on the guarantee and on second charges. So they're not new. What I think the difference is with Proportunity, and I've been working with them for what, maybe over 2.5 years, and when we first met. And the two things that or two or three things that I think is quite unique about the proposition is one, it increases borrowing power, as Stefan's mentioned in the slides there. And you know, in terms of the interest rates that we're seeing out there, a lot of people can afford a lot more if they had the increased borrowing power that this product allows. Secondly, unlike the Help to Buy in the new build arena, this one here allows you to buy second-hand as well as new build. And uniquely, as again Stefan mentioned, which kind of attracted me first of all, was that the individual properties are assessed. So it kind of gives the borrower or the applicant a lot more confidence to think, well, if Proportunity says it's going to be a decent investment, then there's more comfort there. So and you know, and again, if you look at it in the plain light of day, most of the borrowers that are looking to do Help to Buy or Proportunity or the various other schemes that are available out there similar to this, most of them want to pay off the second charge as quickly as possible, interest rates, etc. So I think, you know, on a new build, on the traditional Help to Buy, government Help to Buy, I don't think that's going to be as easy as it looked 5 years ago when they first came in, because we are seeing, and as notoriously on new properties, especially in a flattish housing market, you don't get the appreciation you would get on traditional second-hand properties. So I think that's the two things there that make it quite unique proposition. And we've been doing a number of these for the last 2 or 3 years. And they're attracting, especially in the London area, some very good quality borrowers. And yeah, absolutely. And I'm a great advocate.
Walter, that's interesting what you say about quality borrowers. Is this type of deal suited to a particular type of borrower?
Well, I can only go from my experience in the London and South East area, and you know, the average loan size, the average borrower profile is very good. You know, we're talking 50,000–60,000 pounds average salary coming through. So it does attract certain borrowers, I suspect. Maybe it's the area what I operate in, or maybe it's the fact that the product is easily understood by people who are, you know, more financially sophisticated. I don't know. You know, it's one of those things that we just find that it suits certain borrowers.
Okay, we are getting quite a few live questions in, but I do want to get through some of the questions that have been pre-submitted. Obviously, yesterday was the budget, and final details are still being poured over. I had a question that's coming from Kate Davies. Kate's the Executive Director at IMLA, and she wants to know what your response is to the Help to Buy Indemnity Guarantee Scheme that was announced in yesterday's budget. Mark, what are your thoughts on what was said yesterday? Oh, sorry, Matthew. Sorry.
It's okay. I'm checking it's me.
Yeah,
interesting.
Matthew.
Obviously, the details are helpfully pre-leaked, so we had a bit of a heads up of what it might look like. And then obviously post the budget, we see more detail as well. And as Stefan pointed out, and as Walter knows, it's very much a rehash of the previous scheme that ran from 2013 to 16. Now, alongside the existing Help to Buy equity loan scheme, that saw some take up. But it kind of was shut down because basically banks decided that they could do it better themselves and with more freedom. So this is designed to be a short-term scheme. I understand it's going to run for just over a year, and it's got a limited capacity of around 4 billion. So it might be a useful way just to give people that helping hand to have confidence getting back in the market with a low deposit. But as Stefan pointed out, I think our solution really is addressing two things. The fact that not many people are fortunate to have a 10% or higher deposit in today's market, particularly in London and the Southeast area, where property prices are naturally higher than the rest of the country. And secondly, the affordability question, which given mortgages under regulation need to be stress tested and need to be affordability assessed. We need to make sure that those payments are sustainable. And the rates on these products are yet to be seen. We're going to see it come next month. When we add up the rates and the size of the loan, this could be quite a high burden of debt to be able to afford and pass underwriting.
And just sticking with that, we had another question from Keith Robinson, who's a mortgage broker with London Money. Help to Buy is making the headlines again. What do you think the future of Help to Buy is going to look like? Walter, do you have any thoughts on that?
Well, I mean, it's looking to be phased out eventually, and they've put some limits on property prices around the country. I mean, it's a new build product. It's targeted to the developers as it has been for the last 5-6 years, and as I said before, it's notoriously known that new build properties, in terms of appreciation, don't appreciate as fast as second-hand properties in general. So I think it will carry on. It will be there to help the developers, and with the government's target on house building, who knows, it could go on beyond the 2023. I think that's the key, that the targets that the government have set themselves. I can see it being extended and necessary for those targets.
Okay, Walter, just sticking with you for a moment. We have a question that's coming from one of your former colleagues, Ray Bolger from John Charcoal. It's a typical Ray question, so here we go. Perhaps, Walter, if you give this a stab first, and then Matthew, I'll come to you. The properties financed by Proportunity in the first 2 years of its operation have now been owned long enough to compare their capital gain percentage with the market as a whole. How does the average capital gain achieved by using the model to select undervalued properties compared with the average as per the UK house price inflation? Thank you, Ray, if you're watching. Walter.
I'd love to give a cogent answer to that one, but I haven't got the stats in front of me that I suspect the guys have on their performance of their book. All I can say is that there are certain loans that we've been involved in over the last couple of years, which, if they haven't been paid off, they've certainly been a fair chunk has been paid off. Now, whether that's because of house price inflation or because incomes have grown and they can afford to effectively staircase through either a further advance or remortgage, but in terms of house prices, they've been averagely flat over the last two years, apart from the bit we've had this past few months. And in the past, I mean, I've had occasion to speak to clients over the last 6 months, and their new build properties they bought 5 years ago has hardly moved or has actually come down in value. So again, that's pretty that's a new build phenomenon. But I think Matthew or Stefan, if you've got your stats from the loans that have matured or been paid down or whatever, probably raise our question can be answered a little more fully.
We'll do our best. Thank you, Ray, for your question as always. Yeah, I mean, obviously we're quite a relatively young lender. We've been around for 2 years. Our core product is a 5-year fix. So customers who are choosing to prepay or repay during that period do face the concept of early repayment charges. But we have had on our portfolio sort of 3 or 4 people who have redeemed in full. And, I wouldn't like to say that there's a consistent trend, but we have been fortunate enough that each of them has delivered close to double-digit returns per annum. So yeah, I think we're doing something right. I think the skill of our model isn't to try and become an aggressive, property investor. Others do that a lot better than we do. What we're trying to do is mitigate making poor lending decisions. As Stefan said, we try and risk score the property just as we all credit risk score the borrower. And I think if you get both right, then you kind of feel a bit more comfortable lending at higher LTVs. And so, yeah, we've been comfortable with our book to date. We've reassessed it. And it's really up to the customer to when they want to choose to repay. We are a long-term lender. Our loans extend for up to 40 years. So, we want people to buy the home they want in the right area at the right price, and hopefully sell it for more than that they started with, and avoid making poor decisions. So it's been I'd definitely say it's outperformance, but I guess there's devils in the detail and in the sample size.
Let's look at some of the live questions we've got coming in. Alan Mudd wants to know if there are any restrictions on construction type. Stefan, that?
Yeah. So I guess in a way it needs to be eligible with a main bank as well. So you would need to get a first charge mortgage in place for a particular construction type. So that means getting a first charge mortgage from a high street bank or building society. So whatever that means from a high street bank or building society criteria point of view. I think from our perspective, and Matthew, correct me if I'm wrong, you're the policy guru. We do sort of fit in the way the main banks do assess these in terms of criteria.
Okay, and let's take in another one here from Douglas Cochran. Douglas wants to know, what are the costs for the second charge loan in terms of fees, pay rate, additional conveyancing costs, and what are the repayment terms? Yep.
I mean, because we're talking to an audience here of intermediaries and this is an advised product, we obviously wouldn't want to quote an individual rate for an individual circumstance, but I can talk about a representative example. Our products range from $6.99 to $9.99, but our average is around 8.5 pay rate. It's an interest-only loan. Some solicitors are pretty happy just conveying with both loans. There is perhaps a marginal additional cost of the conveyancing, but nothing material that we've noted. And the repayment term, we match it with the main loan. So if this advice from the intermediary is that a 30-year or a 35-year is available and suitable, then we'll match that term. Only with the proviso that our product is initially a 5-year fixed rate.
Okay, we've had a couple of questions in very similar from John Wallace, Farrell Rabinowitz, and Adam Hosker from Bespoke Finance. Generally, Adam says, we've had difficulty with top-up mortgages before, as your second charge requires first charge lender's consent. Which lenders does this work with?
Yeah, a great question, and that's probably one of the biggest challenges with the business. I mean, having worked with Walter over many years, we got some pretty good relationships with most of the lenders, and certainly we've talked about the Proportunity concept with all the high street lenders, a large amount of the building societies, including via the Building Society Agencies Forum, Association Forum, and with specialist lenders. And we have a handful. So we have high street lender, we have a building society, and we have a specialist lender who are happy to support our lending. We would look to expand the number of lender partnerships. But guess what? Lenders have got probably bigger fish to fry at the moment. They've been dealing with a lot of issues, and they've been throttling down on their non-core products, such as higher LTV. So it's a pretty difficult conversation to get the green light to move forward with many organisations in the last year or two. I guess I'd like to say is, when we set up the business, of course, we were MCOB regulated from day one, from the day of the Mortgage Credit Directive, so back in 2016. So we built ourselves as a lender to be compatible with modern advised first charge lending practices. And really, as Steph rightly said, if one of our partner lenders would give a loan based on construction type, based on customer credit, and based on eligibility, then that's really very good sign that we would match that as well.
Okay, I noticed at the start of your presentation, Stefan, you did focus on a heat map of Hackney in central London. Ken Payne is a principal at Legacy Legal. I think they're based over in Wales. He wants to know if you lend outside of England and Wales in particular.
Yeah, we do. We do lend across England and Wales. I'm just going to share my screen quickly because I have an extra slide here that I didn't show during my presentation. 1 second, please. Okay, share. There you go. Can you see my screen? Yeah. So this is obviously Hackney, right? So we don't lend only in Hackney. This is just a heat map of how basically growth patterns evolve here. But we do lend across England and Wales, and this kind of shows a heat map of where we lend across this. And here, you know, we look at data at a very granular level. So a couple of streets in a neighborhood is not even a ward or anything. It's just a couple of streets. We're looking at around 1,000 residents roughly, and we're able to go at that granular level. As you can see from this map, we're pretty much focused on conurbations or, you know, high density urban areas. But these are across the country, right? So we don't just focus on London and Southeast. We do lend across England and Wales. So yeah, in short, we do lend in Wales.
Okay, just looking at the live feed as well. We do, not sure about the sensitivity of this. We do have a couple of people wanting to know which lenders you're working with. Alex Hyde, Jonathan Burridge, and a couple of others, David Walton, I think, as well. Is that something you can reveal, Matthew?
I mean, I think if intermediaries are interested in showing us business and we want to place cases with those lenders, we can help you introduce to them. As I said, high street lender, building society, no one out of the ordinary. We can play a guess game. It's not something we really want to talk with to protect their sensitivity as well.
Okay. Got a question here. Going back to you, I think, Stefan. Both Cindy Mellor, I think you may have just touched on this. Cindy Mellor from Total Mortgage Solutions wants to know if this is area property type specific. Well, we know you go throughout England and Wales. You have touched on property types. Philip Lawford, Business Development Manager at Saffron Building Society, he wants to know what Proportunity's plans are in terms of expanding those areas where you will lend in. Would you have any plans to go into Scotland, for instance, Stefan?
Yeah, so I think in a way we're, you know, as a lender, we would want to lend everywhere in a sense. To an extent, we're restricted by our technology, and the technology is restricted by the data we have. So we need data sets that are, you know, are able to feed our machine learning model to give us accurate, you know, present values of properties as well as accurate forecasting for those properties. As we expand our business and we you know, we grow, with definitely obviously the obvious thing would be to go and to expand across the UK. So but it's a data element we take into consideration. Do we have sufficient data to feed our machine learning model before we deploy capital in a particular area?
Okay. Douglas Cochrane's come back with another question. If Proportunity use the first charge lender's valuation, how does this work where the lender uses an AVM, and how is the valuer's liability shared between the two lenders? Matthew, is that something you want to?
I can take that. That's a great question. Yeah, obviously, you know, as we said, you know, we are first a data company, so we do our own AVM, so we provide our own valuations for our own lending decisions. Clearly, we want to be, you know, in line because the LTV limits on both lenders' products, and so we need to be aware of the first charge lender's valuation process, particularly if it's been a physical valuation and throws up any, you know, parts of the condition of the property that we all should be aware of, and also that we see the same examples of inspections of how long, for instance, the lease has to run, and any service charge and ground rent. But fundamentally, we do not rely upon the first charge lender's valuation, whether it be a physically instructed one or even an AVM. And as we know from this time last year, a lot of the industry moved to more AVM type approaches, particularly for lower LTVs, both from a service point of view, but also just it wasn't physically possible to go and inspect properties. And I think we're advocates of that. We think you can do pretty much a good job for the purposes of prime lending from assessing the characteristics of the property and its neighbours using data and using sources as you can by walking past the clipboard.
Okay, and another one here from Jonathan Burridge, who says, as Walter says, the concept behind Proportunity is not new, but he wants to know, maybe unfair, where has Proportunity got it right, where, say, Castle Trust got it wrong? Matthew, is that something you want to?
I can have a go. Maybe Walter will want to chip in as well.
Yeah, Walter, that.
Well, this is a completely different concept, and this is a traditional second charge top-up loan. I'm not aware of a similar one from Castle Trust. I may be out of kilter there, but I'm not aware of it. I know there are other schemes that are in operation through local estate agents have them, but this is a completely new concept in terms of how it's structured. It's very similar to the first charge. It's done in the same conveyancing way as the first charge. As I say, that's for me, that's the beauty of it.
Yeah, and I think to add to that, I mean, there was for a time a Castle Trust product which had similar shared equity elements to it. I think the thing that's different here is that our funding model doesn't rely upon selling investment bonds to retail that are linked to house prices, particularly when the returns on those are not exactly linked to the returns on the mortgage, to give the profit in the middle. And also that the fact that, as I recall, the Castle Trust scheme was not a 1-for-1. So if your house price went up by 10%, it wasn't just 10% more you had to give them back, it was a different ratio, which we've been very, very clear that we are a 1-for-1 lender, working a bit like the Help to Buy scheme. So if we offer a fixed percentage at the purchase of the loan, say 10% of the purchase price to go alongside the deposit, 10% is always what you will owe us if your house price goes up, down, or remains the same.
I'm just out of interest, on any of the loans that have been redeemed so far, have you had any issues with the increase in equity value that's had to be repaid? Has that been an issue for any clients at all?
No, as we said, we're a long-term lender, so it's really the option of the borrower to choose if they want to and when they can repay, but they can repay freely at any time. The first 5 years being fixed rate would have disclosed early redemption charges in place, and then it's really a combination about what are the circumstances of the borrower. The ones where we have been repaid have been a combination of people where they have gone in to become either a salary raise, or they've come into some money from their employer, or they've rescheduled their finances to be able to save and repay us in part or in full. And where the house price has gone up and they have to pay us a little bit more at that point in time, they're delighted, because guess what? They've got 85% normally or plus or more of that increase, and our share of that has helped them achieve that. So we're very much aligned, and certainly, borrowers who've repaid us have been, good customers that we're happy to have helped, and those who remain with us, we're still happy to help as well.
And a question here from Philip Tofield. He just wants to, can you perhaps talk us through briefly the typical application process, including the involvement of the first charge lender?
Steph, do you want to go to that one, just for change?
Yeah. So I'll keep it brief, or at least high level. So in a way, it all starts with the property. So we have an automated tool that the intermediary can use even during the conversation with the customer to check if a property is eligible based on purchase price, postcode, and surface area in square feet or square meters. They do this instantly, even as I said during the conversation. Let's say a customer has a property that they put an offer on, or they're willing to view it. They get an instant decision on that property. They also get the interest rate that's applicable, because then they can have the conversation with the customer on the potential costs involved and financial advice. Then if the customer gets an offer accepted, the broker would kick off obviously they will go through the advice stage. They would have an illustration from the main bank, then they would have an illustration from Proportunity. They would discuss these illustration in a ESIS, sort of European Standard Information Sheet format. They will discuss it with the customer. If the customer wants to proceed to application, the broker would first apply for the first charge lender. Then they would apply for the Proportunity product. Obviously, the first charge lender requests a valuation. The valuation comes in. We accept that valuation. Then the first charge lender offers. After valuation has been conducted, all this time the loans are being underwritten by the first charge underwriters and Proportunity underwriters. Then again, there's no point in us offering before the first charge offers, so we wait for the first charge lender to offer. The offer comes in, then Proportunity offers, and then everything gets bundled up to the same solicitor who starts the conveyancing process. So we've designed it in a way to kind of follow in the footsteps of the first charge and run some things in parallel. Like, if we have the bank statements, the pay slip, all the customer information, we don't have to wait until the first charge offer comes in. We can do our underwriting in parallel So there is a small lag between when the first charge offers and we offer.
Okay, and just Alex Hyde from, he's the commercial director at Mortgage Bureau. He just wants to know if you can, just to clarify, the product, does the product exclude new build, or does it include new build? And also, will distribution be via all mortgage brokers or selected specialist firms?
Yeah, great question. So we started off this business by basically noticing the gaps in the Help to Buy product and the limitations of the Help to Buy product. So our intention initially wasn't to cannibalize Help to Buy, was to complement it in the sense that offering a similar type product to the secondhand market, because people wanted an equity loan, but they didn't necessarily want to pay a premium from new builds. As we grew over the past couple of years, and as Help to Buy is tapering and eventually ending in 2023, more and more people come to us to ask about new builds. Or in the past, they came to us with new builds because they weren't eligible for Help to Buy. For instance, they might have had a property in the background, or that particular developer wasn't registered with Help to Buy, or the price were, some of the conditions weren't met. But now, as Help to Buy tapering and eventually ending, we do see customers coming more and more to us with new builds, as well as developers and big and small and medium developers coming to us and saying, okay, how does this product work? Can we do something around it? How are you guys working to replace Help to Buy? So we're having increasingly more and more conversation with developers and the new build sector with our product, because fundamentally, as I said in the presentation, we're the only working solution for an equity loan, and the only basic equity loan scheme that works like Help to Buy in the market right now.
Okay, Douglas Cochrane's come back. I think Douglas is getting quite involved in this now. Douglas wants to know, in a falling market, does Proportunity take the full pro rata hit on the reduced value, or is there a floor whereby there will be a limit on how low the value of the second charge will fall?
Yeah, good question. So as Matthew said earlier, we're one-on-one relationship with the customer in the purchase. So if we help with 10%, there's no floor or ceiling to the way the property can appreciate or depreciate. So in a property price context, in a context where property prices go down, we also take the hit. So the customer can decide, I don't know, if property prices go down significantly, they can decide in year 3 they want to pay us back because it makes sense for them. There's no limitation from our side. As an FCA regulated lender, we do enable the customer to pay whenever they want, and we offer that possibility. And they pay. It's a one-on-one relationship. We don't take more or less of the hit, neither more or less of the appreciation.
Okay. Now, Mark Parker, an advisor with AFP Northwest, wants to know about multiple sources of funding. Is that allowed and how it would work? I assume he might be talking about the second charge, but Matthew?
Yeah, I think it is, as Walter said, this concept of what we're doing is nothing really new. It's been around before, and Help to Buy is effectively a similar product, and it offers a first and a second charge loan when buying a home. And lenders are happy with that, and the process goes through obviously standard conveyancing and purchase. We've come in now under MCOB as a regulated version of that, and knitted together a process which allows us to offer a first and second charge for purchase. As people are pointing out on the chat and have asked the questions around, not every lender fundamentally accepts that, or B, because of through policy, or is able to accept that under current policy without some changes. So there's a bit of work to be done to add to that panel, but people are moving in that direction, because anybody who has been able to accept a Help to Buy commitment as a second charge alongside their first charge is most of the way there.
You mentioned a little bit of work to add to that panel. Cami Amira, from Director of Sales and Marketing at Tipton and Cosley, wants to know if you plan to limit the number of lenders you deal with.
Dealing with lenders is part of the parcel of the game, and I've spent many years doing it. We certainly can't go with every single lender. We don't have the bandwidth to follow all their criteria, so it will never be a true whole of market solution, I believe, unfortunately. There are sort of products out there, obviously, that allow brokers and ourselves to rapidly and consistently check the criteria, which often change for a whole panel of lenders. So we're getting better at that through data. We will be looking to add to lenders. We don't have all our eggs in any particular one basket, whether it's high street, specialist, or building society. But I don't think we're going to go crazy and be able to have every single lender compatible with us. If we did, then that's a good solution for everybody, because it means we're doing lots of business.
And sorry, Stefan, Alex Hyde just wants, he says, does that mean yes or no to new build properties currently?
Yeah, sorry, I just realized I didn't answer the full question, and the bit that I did answer, I didn't answer directly. So yes, we do lend on new builds. And secondly, the point, I think, the second part of the question was around working with master brokers. I think it depends on the advice authorization of brokers, right? If they can do first and second advice, then fine. It's an ideal situation where the customer sort of talks with a single broker. But we also have a process where we can involve a master broker for the second charge bit. So we do cater for that as well.
Okay, we've had a couple of questions about qualifying client criteria. I think Rajesh Solanki is asking, are foreign nationals essentially accepted also whether foreign with visas?
Yeah, as we said before, we tend to follow the application criteria and eligibility criteria of our partner first charge lenders. So where their visa and their right to remain is eligible there for work, then we'll follow that. We don't have any more onerous decisions on foreign nationals or on visa requirements. Obviously, it's quite a complex area, and obviously, as we've gone through a transition with our relationship with certainly our nearest country neighbours, that seems to be evolving. So it's probably something to watch this space to make sure that all the right to remain, right to work, etc., remain in the same way going forwards. But nothing out of the ordinary with my simple answer.
Okay, and Shabir Razvi, Managing Director of International Financial Solutions, he wants to know if the scheme is available to those who have had furloughed income in the last 12 months.
We're open to that. I mean, we have lent to people who have been furloughed. So the simple answer is yes. In each of those cases, we had a letter from the employer saying that furlough process for that particular employee was coming to an end, and they're being reinstated into a full-time job and confirming what that salary was. We've all suffered and been through a difficult time and still going through it, I guess, over the last 12 months, as you rightly said, Robyn, at the start of your presentation. And we can't use that as an excuse to not lend. We've been lending consistently through that period. We've got challenges though, and so we need to make sure that we lend to sustainable income and make sure that customers get the right advice to take on loans that they can afford and repay.
Now, obviously, the pandemic has created a lot of distress amongst clients and the public. Douglas Atherton, a broker from Atherton Mortgages, wants to know what degrees of adverse credit would be acceptable.
Yeah, currently, we're not focusing on that market as a solution. As we said, we're a relatively young and small lender in the big scheme of things, and we do try to focus on prime customers to start with. We have started working with a specialist lender, and I think cases where there has been a light blip of explainable historical adverse, maybe a skip CCJ on a mobile bill or a utility bill that can be kind of explained as being settled, and in his aberration that has a story behind it. We're happy to take a look at that as long as the first charge lender we're working with has the same view. And there, I think first charge lenders who, the one particular building society we started to work with, we're very happy with, takes a manual underwriting approach. And I think some people cases don't fit the larger banks, computer models or systems or processes. We want to make sure that each customer's circumstances can be thought about in the whole. And so there's always, a question to be asked about whether something that's absolutely not perfect can be considered. And I think a fair and balanced answer is what should be expected.
Okay. Walter, I just want to bring you back in for a moment. Marie Spolnicki, an advisor with Al Financial, she wants to know if you've got any advice on what's the best way for buyers to pay off their Propertunity loan if they weren't able to save up for it in the 5-year period.
Well, in the same way as the normal Help to Buy, it's either using own funds, a further advance from the lender, from the main lender, or remortgage. And obviously that depends on, if the property is appreciated in value, client circumstance, but those are the traditional ones: further advance, a remortgage to take it out, or the savings, which obviously, as the question suggests, there wasn't enough. But it's just exactly the same as Help to Buy.
Exactly the same. So long as you can understand Help to Buy, this really shouldn't be too difficult.
Absolutely, it's exactly the same. Yeah.
Maybe understanding help to buy a different issue entirely. Becky J, she's an SME banking specialist at Starling Bank. She wants to know what your predictions are for property prices for the rest of 2021. Are we expecting a cliff edge at the end of the stamp duty holiday? Now, I guess with the equity loan element of the Proportunity product, property prices are fundamental in some ways. So maybe if we can hear from each of you, what your thoughts are for the next 6 to 12 months, say. Walter, let's start with you.
Well, I'll take the popular view that we're not going to see a dip. I mean, we haven't got a cliff edge. It's kind of, we've got two little hill edges, haven't we? Really, coming in June and September. So again, demand is out there. I can't see them going anywhere fast, up or down. I think probably a flat market, maybe slightly up by the end of the year. But remember, we've got the mortgage guarantee that will bring people into the market, number one. And secondly, the stamp duty extension is going to create more interest over the next 3 or 4 months. So I property prices, I've seen lots of estimates of what's going to happen to property prices over the next year or so. I think it's steady as she goes. It's the same as lending. What market will be this year? 250, 260 billion. It's as long as it's wide in terms of estimates. Maybe we should ask Mr. Bolger. He's the guru on house prices. Maybe he can, if he's on the line, get us to give an explanation. We've only got a few minutes left, but so Ray, hurry up.
Yes, hurry up, Ray. In the meantime, though, Matthew and Stefan, what's your view on where house prices are going to go?
Shall I have a go first, Steph? Yeah, I think it's the one thing I guess we all learn, and certainly for our business we look at is avoiding short-termism. I mean, nobody's got a crystal ball. Our data cranks lots of analysis on historic trends and influences to those, whether it's types of business opening, closing, crime rates moving, school reports of quality going up or down, and all these have an influence, as does fundamentally supply and demand from people who have the confidence to buy and own homes, and how desperate people are to sell, alongside interest rates. So it's a complex model. I think really the secret though is not to look short term. Our product is a 5-year fixed rate for a reason, and that's really because we think over that period of time, someone buying a home at the start, where we can say that it was bought at the right kind of area at the right kind of price, and most importantly, not the wrong price and not the wrong area, stands a good chance of being worth more in 5 years' time than not. And I think if you look back over all cycles, a 5-year period of the housing cycle is enough to kind of basically get you back to at least where you started, no matter when you picked and bought your home. So I'm more confident in long-term sustainability and less worried about short-term volatility.
Okay, and Stefan, would you agree with that?
Yeah, no, definitely. And I think from our business perspective, and this is where our machine learning tech comes in place, and why we put so much emphasis on it, is that and we look a lot, we look at all the we analyze data for decades. And for example, if we look at the 2008 crisis, right, it's not similar, it's a different context, but the key element I've kind of taken away from that is that even if house prices on average have gone down, there's still, across the country and London and Southeast and across the country, basically, there are still pockets that outperform average. Even in the worst case scenario of house prices going down, there'll still be areas where house prices will appreciate, because to my mind, regardless of what happens with the market, there's still the fundamental rule of supply and demand, which will rule the market going forward. And I think it's known the market there's not sufficient supply. So that, I think in the medium long term, that will drive the market. In the short term is very difficult to tell, but we do believe there are these pockets of growth, and what we're trying to do through our tech is help people find those pockets of growth, so they get on the property ladder the right way, not just get in any way. So I guess that's also the difference between us and Help to Buy, because we also put this tech in the hands of the customer.
Well, I can tell you Ray Bolger has been in touch, and he says that I agree with Walter on house prices. A fairly flat to a small rise this year. I expect the FPC to loosen one or both stress tests at its meeting next week, and along with the SDLT exemption, that will also help values. So thank you, Ray. Thank you for watching. Very quickly, we do only have a couple of moments left. Walter, to any brokers out there that are watching, have not used Proportunity before, what advice would you give them, and what would be your message to them now?
Look, it's another product in the armory. It's different. It's, as I say, in the mortgage market over the last 20, 30 years, there have been very few different products out there, especially recently. It's a different product. It gives you more affordability. It brings down the overall interest rate if you mean up the interest rate, as Stefan showed on his graphs. I just hope that the lenders that are taking the 95% guarantee have the same attitude in terms of loan to values. Will they charge the 3+%, or will they look at doing a lesser interest rate because they're getting guarantee, although they're paying for it? But in terms of Proportunity, it's not a difficult concept once you get your head around it. It's fairly easy. It's something different to talk about to clients, and it does get you the cases you wouldn't normally get. I think it's for a type of client and for a type of property, it's an excellent solution.
Matthew and Stefan, in your remaining 60 seconds, what would you say to brokers that are watching this, and what would be your takeaway for them to go away with?
Yeah, I think, following what Walter said, we think we've come up with a reasonably good solution. It doesn't fit everybody's case, but is pretty much a mainstream solution for, the young aspiring homeowner who doesn't have, huge amounts of savings, or thought they did until they looked at how much house prices cost, in a steady job with potential, and who wants to kind of own a home and be a homeowner. So I think that's the way we want to attract that kind of customer inbound. I think that, as Walter said, is once we've explained how our process works and the first couple of cases, it becomes pretty self-evident. But we are expanding. We are looking to grow. We're looking to increase our number of broker relationships. We are, however, still a small team. So we can't say yes to everybody. We can't open the taps to every single inquiry. And we do think about each customer, each property, and each loan still quite carefully, so we make some wise decisions in our early years. So please reach out to us. We'd love to talk to you, but just be a little bit patient if we take a bit of time to speak to you.
Well, thank you all very much. I think that does bring us to a close. As Matthew just said, if you do get in touch with Proportunity, they'll be more than happy to speak to you. So thank you to Matthew and Stefan from Proportunity, and of course Walter, and thank you at home for watching. You will be able to watch this broadcast again via various social media and also in the Mortgage Introducer website, which can be found at mortgageintroducer.com. I'm Robyn Hall. It's been great having you this afternoon. Thank you. Keep well, stay alert, stay safe, and goodbye. See you soon.
All right.